Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 25th September. Coming up on the show, struggling Intel seeks an investment from Apple. President Trump is expected to sign a deal for TikTok today. And we'll look at the stock that's up nearly 1,400% in the past 3 months. So grab your coffee and let's own the morning. Well, the first thing you need to know is that Intel has approached Apple about securing investment in the struggling chip maker. According to Bloomberg, the two have discussed how to work more closely together as well. Well, the news has sent Intel shares higher in the pre-market, well over 3% in fact. Now, remember that Intel is now partially owned by the US government, and just last week, Nvidia made a $5 billion investment in Intel. And also Japanese tech giant SoftBank announced a $2 billion investment just last month. Now, Apple switched to in-house processors 5 years ago, and it does seem pretty unlikely that it will switch back to Intel. OK, the next thing you need to know is that the Trump administration last night said it was formally implementing the US trade agreement with the European Union, confirming that a 15% duty for EU autos and auto parts began on August the 1st. Now, the tariff drop from 25% to 15% will ease worries in the industry that had been waiting for the long delayed confirmation in order to make sourcing decisions. Now, shares of German car makers, well, unsurprisingly, they were all higher. Now, Washington also listed tariff exemptions for generic pharmaceuticals, aircraft and aircraft parts. And the last thing you need to know is that later today, President Trump is expected to sign into law a deal allowing the sale of TikTok's US operations to a group of US investors, including Oracle. The popular site is currently owned by ByteDance, a company operating out of Beijing. Now, under the agreement, ByteDance will hold less than 20% of the stock of the new company. Now, this deal is an important part of the US-China trade negotiations. OK, now the White House Budget Office is telling federal agencies to prepare plans for mass firings in the event of a government shutdown. Well, Terry Haynes, founder of Pangea Policy, earlier gave his take on a potential shutdown here on Yahoo Finance.
The politics are that the Democrats need to show that they're willing to stand up to bad orange man, and Schumer got a lot of grief about this a few months ago, making a deal over an earlier shutdown threat. So they're going to have some sort of performance. At the same time, the signals Democrats are sending is we're willing to back off provided we get some agreement on a compromise on premium Obamacare plans and premiums for Obamacare plans. And Republicans in turn have signaled that they're willing to talk about making a compromise there, just not in a temporary spending bill. So what you got is a situation, I think, where there's a signal from the Democrats, and at the same time what Republicans want to signal is that, look, we're not the people that are making it difficult to deal with debt and deficit. These other folks are. The Democrats are. So it serves both of them to have a little performance this week and next. But traditionally, this hasn't mattered very much. It matters more now because of debt and deficit signals. But strangely enough, tariffs have proved to be the friends of the markets here because they're making up on a lot of the revenue that was earlier a concern.
Well, it's another busy day today, not just on the economic data front, but also the corporate earnings front. We've just had earnings in from Accenture and CarMax. For Accenture, the markets were looking for Q4 revenue of $17.36 billion, with adjusted earnings per share of $3. Well, Accenture easily beat expectations. Revenue came in at $17.6 billion and earnings per share came in at $3.03. That initially has sent shares higher in the pre-market, as you can see, up 1%. Now, remember, though, the management and technology consultancy firm is in an environment of falling demand and rising price strains. Its share price is actually down around a third this year alone. Okay, let's move on to CarMax, the largest retailer of used cars in the US. Now, the street was looking for Q2 revenue of $7.01 billion with earnings per share of $1.03, but it was a big miss. Earnings per share came in at just 64 cents, and look at the shares, down over 9% in the pre-market. Well, CarMax shares are down actually around a fifth this year alone, despite up until today delivering market-beating results in 3 of the last 4 quarters. Also out later today, we hear from Costco. It has fourth quarter results out after the closing bell. Analysts expecting both US and Canadian stores to do well, with sales expected to have risen by mid to high single digits. But it's a different story for international sales, likely to show they've hit their weakest in almost 2 years. Now, on the economic front, we'll also be getting housing data out later. Existing home sales are expected to dip to an annualized rate of 3.95 million. The likely decline coming as many Americans face higher mortgage costs as well as higher prices. All right, turning over to the Fed. Now, we're going to hear from a slew of policymakers. In fact, 7 are scheduled to speak, including Chicago Fed President Austin Goolsbee and Fed Vice Chair for Supervision Michelle Bowman. Well, earlier this week, we heard from Fed Chair Jerome Powell, who spoke about the weakness in the labour market. Here's what Jose Torres has made of recent Fed commentary. He's been speaking to my colleague, Josh Lipton.
I think that the statements were way too balanced. When you look at what's going on in the labor market, we got a first month of job losses since the pandemic year of 2020. That was June of this year. That got revised down to negative 13,000. 3-month moving average, we're doing really bad on a historical perspective, only 29,000 per month on job gains. When you look at what drove the 50 basis point cut last year in September, that was 3-month job growth of around 80,000. So we're way below half of that. I think the Fed ought to start cutting more aggressively and start communicating that, because too balanced of a perspective risks an economic downturn at this juncture.
So the jobs market is cooling. Why is it cooling, Jose?
Well, you have a lot of the rate-sensitive, cyclically oriented areas. They don't feel comfortable hiring right now, namely real estate, manufacturing, and small business. Immigration restrictiveness is also a huge deal. You don't have the supply of workers, while at the same time, like Chair Powell mentions, you also don't have that much demand for workers. So it's a confusing situation. But I think that monetary policy is far too restrictive, and that's one of the main reasons why job growth is way down this year.
We'll look more closely into gold prices and what might happen next. Stay with us. Welcome back. Now, you may have noticed that gold has taken a bit of a pause this week after hitting a series of record highs. Yahoo Finance's markets and data editor Jared Blickery looks at the factors that have been pushing up the price of gold and what may determine what happens next.
Gold just hit fresh highs and money is rushing into ETFs, but the true wild card is still asleep. If volatility wakes up, this move can shift into overdrive, and that's what we're talking about in today's Stocks in Translation. Let's begin now with a chart of gold going all the way back to 2019, and we can see that midway into 2020, gold had rallied to a fresh all-time high that topped $1,900 an ounce. But it would be another 3 years before gold would truly break out and rally again. But all of these years of sideways chop would provide fuel for the next rally higher. And we can see 3 distinct ceilings that emerged recently as gold stair-stepped higher. And according to the work of Todd Sohn at Strategas ETF Research, ETF flows have been confirming these moves, but even though we've seen some spikes of money rushing into ETFs, it hasn't quite reached euphoria levels that has capped gold prices in the past. So in other words, there could be more room to run. So how far can gold rally? Let's zoom out with a longer-term chart of gold futures, which stretches all the way back to 2000 this time. And we can see here how gold rallied for a solid decade from 2001 to 2011. And remember that sideways action from the prior chart? That was only part of a larger sideways trend that lasted about a dozen years. And you can see that between the 2 dotted lines here. But at the right of the chart, focus on that now. Notice the strength and slope of the current breakout from that box. The trend line is very steep, so there will be pullbacks, but the initial thrust is very strong, and we're up about 250% from those 2016 lows. That's not even half of the 650% move that we saw earlier this century. Now, let's take a look at some of the factors that's propelling gold higher right now. First up, central banks. They have been the biggest buyers of gold over the last decade. China and Russia, they started de-dollarizing in the teens, and now other central banks have been piling on. If central banks paused or actually sold gold, that would be a major headwind for prices. And we just talked about the recent ETF bid. It's not quite as important as central bank buying, but you don't want to see sustained outflows. Then we've also got dollar and government treasury yields. A weaker dollar and lower rates, those generally support gold prices. And 2025 has all been about dollar weakness, which is bullish. So right now, longer-term rates are a little bit elevated, and some investors are going to dump gold and buy bonds to lock in those higher rates. But the Federal Reserve is cutting once again, which is generally bullish for gold. Also, gold can benefit as an inflation hedge and an Armageddon hedge. So geopolitical uncertainty and higher inflation, they can be bullish for the yellow metal. Now here's the kicker. We've got one more chart of gold futures over the last 5 years in white, and we've added the ticker for gold volatility in blue, which is GVZ, which you can find on the Yahoo Finance app. You can think of GVZ as the VIX of the gold market. It's based off gold options, but unlike the VIX, which tends to move opposite stock prices, gold volatility tends to rise and spike higher as gold prices rally. So GVZ is relatively quiet right now, but if it starts lifting with gold prices, that can start a bullish feedback loop. So to monitor the gold fuel gauge, watch those gold flows in GVZ. If they get truly extreme, then watch out for a pullback in price. And we probably won't get any big reports of central bank gold buying until about early 2026, but keep that on your radar. Then also watch the dollar and rates. Lower tends to be bullish, higher leans bearish. Finally, if you like to trade the day-to-day swings, watch for surprises in the monthly inflation reports. Geopolitical headlines can also move gold, but you really don't know when those are going to strike. Bottom line is, gold prices and flows are already in gear, and the wild card is volatility. And tune in to more episodes of Stocks in Translation. We've got new episodes dropping every Tuesday and Wednesday on the Yahoo Finance site. You'll find them there or wherever you find your podcasts.
Great insights from Jared there. Now stay with us. We'll delve into the meme stock that's up more than 1,300% in just 3 months. It's time now for today's trending tickers. Now, H&M shares, they're surging. They're up over 8% now after the Swedish retailer posted a blockbuster third quarter operating profit. It jumped to 4.91 billion crowns, up from 3.51 billion a year ago, as customers snapped up its autumn collections that easily beat analyst expectations. CEO Daniel Erver, who took the reins back in January 2024, has been pushing trendier styles to compete with the likes of Shein and Zara. But H&M is warning that looming US tariffs will squeeze margins in the current quarter. That headwind is definitely worth watching as the apparel chain shifts some sourcing closer to America. Now, Tesla is in the spotlight as we just got some fresh European sales data. While the stock is almost stable this morning, down about 0.5% and still hovering around 2025 highs, Chinese rival BYD, well, it overtook Tesla for the second straight month. While Tesla sales slumped more than 36%, BYD sold 3 times as many new cars in the European Union last month as it did a year earlier. Tesla's market share, wait for it, is now 1.2% in Europe. Investors remain focused on whether the EV pioneer can make strides in robotics, AI and other areas Elon Musk is prioritizing. Now, on to Opendoor, which has really been trying not to look like a meme stock, but certainly does look like one. The real estate platform keeps seeing big swings. Its shares closed Wednesday up more than 16% and adding another 6.3% pre-market. The catalyst this time seems to be a filing showing that Jane Street Group has taken a 5.9% stake, about 44 million shares, signalling institutional confidence. Positive housing data also helped. US new home sales in August jumped 20.5% month over month. The news is keeping retail traders confident in Opendoor, which is up nearly 1,400% in the past 3 months, while analysts caution that the stock is still highly speculative as well. Now, another stock you need to know about, Hertz Global. The car rental company is popping in early trade, up now about 5% in pre-market after it announced, it's now down 1% in pre-market. Now, it announced plans to expand its sell senior notes and is looking to clean up its balance sheet. That plus earlier news this year that activist Bill Ackman's Pershing Square owns a 20% and a recent partnership with Amazon Auto has Bulls optimistic, even though Hertz still carries a heavy debt load. Now, as you can see this morning, there's a lot of movement we are seeing outside of the mainstream artificial intelligence trade. And that's something many investors are looking at as they question whether AI might be a bubble. Joe Hegener, Chief Investment Officer at Asta Rosa Capital, discussed the bubble risk with Julie Hyman.
We're drawing a lot of similarities between what's happening now and, of course, .com. That's not necessarily a new reference. But the thing I think is particularly interesting, right, is just the timing of market bubbles and what brings them to a halt, I suppose, right? The .com era, the only thing that really popped or burst that bubble was the Fed raising interest rates, right, and kind of that led to the epic crash. But for years, there were commentators and professionals and analysts from 1995 all the way to 2000 that were pounding the table saying, we're in a bubble, we're in a bubble. And they were right. But if you got short in 1995,
right.
you didn't exist by the 1999, and you missed out on 40% plus equity market returns for years to come. And so that's the interesting thing I think that's taking place now is I definitely think we are in a bubble. And so, what do you do at this stage, right? Because we just cut interest rates. And we're looking at cutting more, and there's fiscal spending coming down the pipe.
Right, so there's nothing externally necessarily that would burst the bubble.
If anything, I feel like we're about to pour some gasoline on the fire. And so that's what gives us a little bit of pause, because I definitely think the left tail scenario, the risk to the downside is immense, because by any measure, valuations are very stretched. We're seeing all sorts of these circular deals that we saw in 1998 and 1999 with some of the same players as we're seeing today. And yet it's very difficult for me to actually get bearish right now, because there are so many positive catalysts as it relates to kind of pushing this sentiment towards more extreme levels.
Now, it's fair to say this has been a tough week for crypto. Just look at how Bitcoin is doing. It is down under $111,600 this morning after losing over 1%, in fact about 3.5% this week in the wake of the Fed's rate cuts and bond yields recovering. But many crypto bulls expect a rebound. This is what Zach Pandal, Grayscale Managing Director, told us here on Yahoo Finance.
One of the unique things about crypto is the product structure, and we have something that creates automatic liquidations. And so, trader leverage was running relatively high. We had some short-term flow factors that caused a modest pullback in price, and then that extended with liquidations. This is a typical pattern that we see in crypto markets all the time. I don't see anything fundamental behind the move, more just trader positioning related, and I think the market will quickly move beyond it.
And when we talk about some of those technical positions, even seasonality, when do we typically tend to see the most crypto volatility, and how can investors decipher whether this is a fundamental red flag or maybe more technical in nature?
Well, crypto is in the process of growing up, and the market structure is changing a lot. You have new products, the ETPs that give mainstream investors access to crypto, and a much broader buyer base than you have had in the past. So the concept of cycles in crypto, the concept of seasonality in crypto, these are all things that we're going to need to rethink over time. I'm not honestly sure that any of those patterns from the last 5, 6, 7 years in crypto are still applicable to the market today. It's really a whole new digital assets market with new buyer base, new use cases, and new fundamentals to pay attention to. I would encourage investors to think about those fundamental drivers, which are really twofold. Macro demand for scarce digital assets due to downside risk to the dollar, due to excessive deficit spending. And then on the other hand, regulatory clarity for the crypto asset class in the US, broadening the buyer base, making it easier for a much wider range of investors to access crypto. Those two fundamentals, macro demand and regulatory clarity, have been driving the crypto asset class this year. And I think that continues into the fourth quarter and beyond.
Okay, before we go, we have some breaking news and just in, and it's from Starbucks. The coffee chain owner says it is cutting around 900 jobs and closing stores in a $1 billion restructuring as it steps up its turnaround efforts under CEO Brian Niccol. The shares are down slightly in the pre-market as well. Now, let's check in on the rest of the markets. Let's start with Asia. It's fair to say that shares here took a little bit of a breather, but it's very interesting to note that Chinese tech shares, well, they're continuing their AI-driven run. They're set actually for their 8th straight week of gains, which has never happened before. Obviously, that's helped by the news that we've heard in the past day or two on Alibaba and its big $50 billion investment into AI and partnership with Nvidia as well. We'll see how that plays out. All right, let's move on to the European boards now. And, well, European shares, as you can see, they're stalling a bit. And that's partly down to the fact that bond yields have inched higher ahead of or after those appearances I mentioned earlier in the show of those Federal Reserve officials. 7 of them, in fact, that will be talking later today. Traders obviously are hopeful that they'll get greater clarity on how far and how fast US interest rates will drop. So they're clearly keeping an eye on that and holding fast on the equity markets in Europe. OK, let's turn over to US futures now. And it's really looking like, feels like everyone is sort of holding fire, waiting also on jobs data as well later out today as well. But US futures there, as you can see, just the Dow down just under 0.1%. The others a little bit more. The S&P looking at 0.25% downgrade, and the Nasdaq down around 0.33%. And let's have a quick look at Oracle shares as well. And as you can see, that news earlier that the TikTok deal looks like it will be signed later today by President Trump. Shares down over 2% in the pre-market as well. Okay, that is all we have time for today on Yahoo Finance's Market Brief, Morning Brief Market Sunrise. I'm Ramzan Karmali. Please join me again tomorrow. Later in the stick with Yahoo Finance, because later on Julie Hyman will be here for Morning Brief. So grab your coffee and let's own the morning.